Let's talk more about where we are here in terms of the economy and financial markets. The financial crisis of 2008 happened because global institutions have been taking on way too much risk. So now that a number of banks are paying back their government bailouts, has the industry and its regulators learned from past mistakes? Well, our next guests say a new market-based capital requirement system is the key. Joining us now from Boston is Oliver Hart, a professor of economics at Harvard University, and from our newsroom in Chicago, Luigi Zingales, a finance professor at the University of Chicago Booth School of Business. Welcome to both of you.
Thank you for having us.
You co-wrote a piece entitled How the Tricks That Crashed Wall Street Can Save the World, and your lead involves a comparison with a teenage son who got dangerously drunk at a party. So give us the basis of your theory here. Oliver, we'll begin with you.
Oh, okay. Well, basically our view is that what's been going on with financial institutions is a bit like the alcoholic son, that they've been taking too many risks, but this has been actually profitable for them because the government was always going to be there to bail them out, and that the way to prevent bad things happening in the future is to have some clear rules that they have to live by, and we have a sort of proposal for a kind of good regulatory rule. So we think it's essential to catch these problems, if you like, with the alcoholic son before he or she before he ends up in hospital. You have to actually, do something, and you need some trigger to tell you you've got a problem in advance.
And Luigi, tell us, how do credit default swaps fit into this solution? Played a starring role in the meltdown, and now they come into play with your solution. So detail that.
Yes, the problem is that regulators tend to be always late to the problem, and there is a huge political resistance in jumping the gun and asserting that the company at the bank is not adequately capitalized. So we need a market-based trigger, and in reality, any sort of price that is related to debt of these banks will work, but the CDS price is particularly accurate because the CDS is a standardized market and sort of more liquid than each individual bond issues, and so the CDS price is the best indicator of a firm financial situation. And the superiority of the market vis-à-vis the regulator is that the regulator is subject to political pressure, the market is not.
And the regulators, as I think you're referring to here, Luigi, are looking at the credit default swaps and putting them through a different clearinghouse. Would that alter how successful this would be in your view?
Absolutely. I think that the CDS price that we envision is a CDS price in an organized exchange of CDS that are adequately capitalized, so that the price is indeed a correct market price, market assessment of the risk that these financial institutions might end up defaulting.
So, Oliver, what do you think of the regulatory reform overall making its way through Congress right now? I.e., do you like the idea of the single regulator, the Council of Regulators?
Well, I think some of the things are good, but I worry about regulators having too much discretion, whether you have one or a council of them. The key question is what tells them that it's the time to intervene. I think we're worried, Luigi and I are worried, that without some sort of objective measure of when a large financial institution is undercapitalized, you're going to have a lot of mistakes being made. We saw that in the last crisis with the FDIC regulator intervening too late with banks like Washington Mutual.
Luigi, one more question for you. Some news today that the House Majority Leader Steny Hoyer says the House is considering reinstituting the Depression-era Glass-Steagall Act, which, as I'm sure you know, barred bank holding companies from owning other financial companies. What do you think of bringing back that?
I think it's an old-fashioned solution to a real problem. I think that the real problem is that the banking sector, as it is now, is taking too much risk. And so people revert to what they know, and they say in the good old days, when Glass-Steagall was there, banks were not taking so much risk. But in reality, I think that the intermingling of commercial and investment banking was not the source of the crisis. The crisis here started in most mostly in the investment banking sector, in investment banks that were separated from commercial banks, but spread through the entire sort of banking sector, regardless of the fact that many of these banks were separated. So separating them will not really address the problem.
Oliver Hart, professor of economics at Harvard University, and Luigi Zingales, finance professor, University of Chicago Booth School of Business. Thank you so much for joining us this hour.